Hello, hello. Welcome to the InfoVest podcast. My name is Daniel. It is December 15th, 2020, and we're just quickly going to go over the markets. Starting from yesterday, we did have that gap up in all of the indexes. We did see the S&P, Russell, Dow, and NASDAQ rally during overnight and also into the North American session. We did see those indices reach up higher during the North American session yesterday, but later, as fears started to creep in about a couple of things, we had, for example, fears of this tightening of restrictions. We had the virus resurgence, in addition to the stimulus bill still. Both parties are still working on, and still nothing concrete has came out yesterday. We were expecting Monday to something good to come out, but as that faded, we saw later in the day yesterday, the Dow, the Russell, S&P, and NASDAQ all retrace the rally of North American session. And actually, it was a little bit of a mixed feeling where we had the S&P, the Dow, and the Russell both fill that gap that we had yesterday, and we had the Dow and the S&P continue that spike downwards further than the gap, and we had kind of NASDAQ hold up its retracement, and kind of it was held by strong buyers, which ended up not filling its gap that it had yesterday. So we saw that NASDAQ was the stronger index among the Dow, the Russell, and the S&P 500. So again, this is on the back of many things, as we have mixed feelings. The stimulus bill still being worked out. We had virus continue to rage in the U.S. and threatening of harsher restrictions across the nation, especially New York City, where it warned its people to be prepared for a full shutdown. And the European governments are also tightening measures, and especially Germany being more harder on restrictions. So again, the fear of restrictions, we did see also gold rally, oil drop on high concern of tougher virus restrictions, which could mean less travel, less demand, as they came out with a report yesterday of less demand. And the dollar and the pound were both kind of steady. But as we look at the markets today, right now, we see a pickup in all the indices. We see gold is rallying right now, and we see all the indexes such as S&P, Russell, Dow, and NASDAQ picking up and rallying, with NASDAQ again being the strongest, reaching back to its all-time highs of yesterday's session. And we have kind of somewhat of a slow rally in all the other indices, such as Russell, Dow, and S&P. One reason for tech to be strong today, again, comes down to the virus fears, and also this IPO frenzy of Airbnb, DoorDash, and even Tesla, which is expected to, I think this Friday, don't fully quote me on this, but I think this Friday it's supposed to officially be on the major indices, and we could see that being a major milestone history for the index, and a lot of probably buying and selling, and probably more of an optimism buying, especially in NASDAQ as that approaches, and as also Tesla being included in many of the ETFs, the index ETFs, and so on. We also seen headlines that Moderna COVID-19 vaccine is next in line for authorization. A second COVID-19 vaccine being again granted the emergency use authorization, and this could happen later this week. And we see Moderna continues to be propped it up and continues its bid higher. So that's another positive news, as Pfizer was the first one, and then we have Moderna, which could be rolled out in the U.S. soon. So that's something to keep an eye on. So expect possibly Thursday for a decision from the FDA or some sort of vote to roll out Moderna and approve the vaccine. But on the other hand, it is expected to come out this week, and we do expect some sort of approval as more and more vaccine is being pushed out into the U.S. In terms of stimulus deal, like I mentioned before, there are two pieces of it. One is a $748 billion package boosting education, vaccine, transportation, and other funding, and more controversial $160 billion, which is the second one, which is the add-on of state of local funding married with short-term liability shield for employers. So that is still in talks. We are still expected to hear from McConnell and Pelosi how they will go about doing it. They had many dozen senators presenting kind of their views on these two bills that combine to create this overall one bill. So what to expect is what's coming up is for today, Tuesday, McConnell and Schumer is expected to have a press conference, which could happen around 10 a.m. And they could indicate more about what they will include and what they will exclude from the coronavirus relief bill. So that's something to look forward for Tuesday, and that's something we could also give a reason for why we are seeing this little bit of a rally in equities as more positive news comes out about this stimulus bill. So after that 10 a.m., I believe we won't be hearing much from the House of Representatives until Wednesday. So that's something to look forward to. And as that news came out, and as we see the S&P rallying, we are back close to that short-term trend line where we did dip to around 1640, and we did pick up a bid, and we're slowly edging up higher around 3665. So 3665, we're seeing a bid being picked up there. So we'll have to continue to monitor if this week or next week, but possibly this week, where we could see the S&P move up higher, close to its all-time highs, or even break the all-time highs if we do get a deal this week. So it's quite an important week because we have a couple of things where you have the stimulus deal that is expected to be passed this week, hopefully. So, I mean, that was been prolonged and delayed by these politicians. And on top of that, we have this BREXIT talks. Hopefully by this week can be something resolved, which I'll get to soon. And then on top of that, yet tomorrow we have the Fed coming out. So anything of dovish tone from the Fed, anything to support the markets, more about its bond purchasing program and what it will do to a little bit change the rates, or not change the rates, but the bond purchasing duration program. The rates will be will stay the same, but the bond purchasing duration, if they talk anything about what they will do to control that curve, we could see kind of more of a pickup in equities. But again, those three major news and headlines, and even with the fourth one being the vaccine and the virus, anything positive would help prop up markets. So it's important that you see that this week is quite important, especially before we head into Christmas and before we see kind of lower liquidity in the markets as people move or maybe just traveling, or not traveling but spending time with family, or vacation time is coming up. So it's quite important that we see some positive news and some positive movements in the markets and in these news, so that it could push the markets or move it in a direction in a more of a positive tone. In other news, Biden captures enough electoral votes to win the presidency, and we had, again, remember Trump kind of going into many of the key states and trying to get a win out of those key states, but today marks the day where Biden officially is affirmed that the Democrat has amassed more than 270 votes, which means that in little over than a month, Biden will take over office. And so it's confirmed that we will see Biden moving in, and we will see that Trump's kind of contested election didn't really go through as he planned. So that's kind of the expected in terms of Biden winning. So it's now officially confirmed as the next major step in the process is electing the president come January 6th. When so the treasury yields, we saw kind of a fall in yields and a pickup in bids in the prices of U.S. Treasury bonds. And this is all before the Federal Reserve meeting tomorrow, which I will touch on also what to expect from there. So this week, tomorrow we can expect the Fed coming out and saying something, and again, the expectation is something along the lines that some sort of bond purchasing tweak to help kind of sustain the Fed's mandate of keeping rates low and inflation higher. So I'll get back to that. But just on the bond front, we are seeing right now, we did see yesterday a pickup in bonds as equities fell. And now we're seeing kind of steady prices in bonds and more of the longer end being pushed down in prices, which means that yields are going up on the longer end, and more on the shorter end we're seeing it kind of more steady. So that might be a signal for the Fed tomorrow that they are expecting something to come out in terms of tweaking the duration of the bonds. If not, we could see yields push up way higher, and bond prices, especially on the long end, pushing way lower. So something to keep an eye on. So in other news, oil had a big dip yesterday when the IEA report came out with a report basically talking about the demand being lower than expected starting next year. and they could see that the virus continuing and the lockdown surging, and based on that, they proclaimed that this demand can hurt oil prices, as it will be still a long, steady run for this kind of for the economies, for many economies to come out and start doing well, especially with travel still low and with people going back to restaurants and offices. So it all depends on how things move out with also the vaccine. So, if the vaccine, as I talked about in my yesterday's podcast, if there's kind of a month process for every individual to be fully immunized when it comes to the getting the vaccine, and you need 2 shots, and every person needs that 1 month process, that could put things on a little bit of a slow trajectory when it comes to bringing back the normal economy, bringing back the normal lifestyle that we had 1-2 years ago. So that's kind of the projection from the IEA, is that this low demand could still continue to persist. So we did have oil yesterday fall down, as I look at my charts right now, fall down to around 45.70. But here's the interesting thing. From there, it did pick up quite rapidly. It picked up bids quite rapidly, and now today we're back at where we started from the IEA report. We're at 47.25, and we see this continuously with oil over and over again. Especially in the OPEC meeting, we continue to see bids being picked up after the fall from the OPEC meeting. We continue to see this rally in oil. So this is a major thing to note when looking at such products, that even with the negative news, we are still seeing a pickup in oil. So that continues to be strong. And the one reason I could think of is that even with this IEA demand report that they had, the report on weak demand, we still expect life to come normal sooner or later. It's going to happen. So that's what's being priced in right now in the current contracts in crude oil. Alright, so now let's move towards talking more about the Fed meeting tomorrow, as this will be kind of an important event to watch. So this is its final policy meeting for the year this week. The U.S. Central Bank is expected to keep its overnight interest rates pinned near to zero, and to signal that it will stay there for many years to come, expected to be up until 2023. Many analysts also expect new guidance on on how long the Fed will keep up its bond buying program. The super easy monetary policy is part of the long-term strategy. The Fed is adopted in August to help it navigate a world of persistently low interest rates that limits the central bank's options for fighting downturns and makes it difficult to hit 2% inflation goal. But the central bank's so-called dot plot of interest rate expectations is included to have those projections, and again they will show that expected to show that zero rates through 2023, and that's consistent with the framework if the economy hasn't achieved sustained 2% inflation by then. So, tomorrow, again, this is one of its big meetings where they will push out the dot plot, where the dot plot has expectation of where interest rates will go, and they'll push out information on where the growth of the economy is expected to go. So, if you see in that dot plot, if you see in their expectations that, rates to continue to remain zero by 2023, then great. That is what is to be expected, as we already have seen it. If we see any changes of the rates not being closer to zero by 2023, and actually it's moved back to 2022 or earlier, that will be a big hawkish tone which will freak the markets, stocks, and also push bonds lower and push the yields higher. So that's something to keep an eye on, but the expected is that won't change, and I don't think the Fed will do such a thing. In addition, they have to keep their inflation sustained and achieve that 2% target through its average inflation target, the AIT, which they have announced. And this is the new kind of strategy that they have announced. And to achieve that, they have to continuously see inflation hitting up higher and higher above the 2% mark in order to get that average at 2%. So again, that still remains as expected. And the thing to watch out for was this massive bond buying program. Are they going to do more bond purchasing? If they are, that's a dovish tone, which will see the yields fall lower and prices move higher. And that will push equities much higher than where it is today, as that signals more printing, more support from the Fed. Now, if they don't do anything and they continue their QE purchases, then everything is as expected. We did hear from the Fed that they called out they need fiscal help and from the Treasury, and the Treasury Department has to do something from the fiscal end, and they've done as much as they can. If they push that rhetoric too much, saying that they're not going to do much, or they're going to roll down their QE plan soon, or they sound any hawkish, then you could see kind of a shock or tantrum or dip in equities, and also you could see kind of a hawkish tone from the Fed, which would push yields higher and bond prices lower. Now, if everything is as expected, I don't expect to see much of a change in equities and bonds. Maybe possibly a dip in equities, but we'll have to see if nothing changes. But the eyes are on the duration of the bond purchasing program, because everyone has been talking about this duration being meaning that bond purchasing to happen more on the longer end of the curve than the shorter end. And the reason for doing that is because if traders begin pricing in earlier rate hikes, then the Fed would need to react, either by correcting the market's mispricing verbally, or by doing it through its bond buying program to push down further longer-term borrowing costs through purchasing longer-term securities, which will then trickle down into longer-term rates, such as mortgage rates that Americans use to purchase homes. So if they talk about that, that we will look to purchase more longer-term securities, more longer-term bonds, then that will signal more of a dovish tone, which means that they will do whatever is needed to suppress yields, to keep it down, so that you don't have any of this market mispricing, or even traders kind of front running and earlier pricing rate hikes, especially in the longer end of the curve. So that's something to keep an eye on when it comes to the Fed. So any of that dovish tone will be great for equities, depending on the level of dovishness. Also, if it's just expected that we hear this dovish tone, maybe you might see a little bit of a rally, maybe a push up, but the magnitude depends on how dovish, and what I would explain as a massive dovish is if, the Fed comes out and says we're going to buy more, print more, and we're going to do more, which would be kind of a flip when they were saying previously that they were depending on the Treasury, depending on fiscal policy to help out. So if they completely flip and they say, okay, we're going to help out now, then that will bring a lot of optimism in equities for sure, and we could see bond prices fall and bond prices increase and the yields fall. So that's something to watch out for tomorrow's Fed meeting. All right, in other news, London was hit by the toughest COVID rules from Wednesday, and as the cases surge. Also, the health secretary mentioned something about a new variant being linked to the surging cases, meaning that this virus is mutating, and they're seeing this virus is mutating, and that is increasing into this surge of cases. Now, to give you a little bit of context and background, this mutation that you hear is quite common with many of the viruses and is quite expected. Mutation does happen. It is expected. But in terms of linking this to the markets, it's something to keep an eye on with this vaccine, with this news of this mutation, because if hypothetically, I'm not saying that it will happen, but if hypothetically you start to see more of this news of this new variant surging, the vaccine not doing much, and especially if that vaccine that is being rolled out today doesn't end up helping with this new variant or this new mutation, you could see probably a panic sell-off or a leg down, especially if this continues to add and more cases start to show up. And it starts to create a really concrete evidence that, okay, all this vaccine is not really working out, is not panning out, it's not slowing anything down, the cases and everything. So that is expected, that if it were to end up like that, in a negative tone, we could see this kind of knee-jerk down in equities. So something to keep an eye on. Other than that, the pound continues to show great momentum in the upside, continues to show a bid. We had that Sunday gap up, and it still hasn't, the pound still hasn't reversed or kind of filled up that gap up, so we're still seeing strong buyers. We're at one spot 33 handle as we speak, close to that 134 handle. We're high up there, and so the Brexit trade deal still continues. The rhetoric is that talks are still continuing. There's still there's still life in the talks, so that's keeping the pound higher. And the expectation is, again, this week, like I said, is very important, that we could expect some sort of Brexit deal, hopefully, is what the markets are anticipating and what the bidders in the pound are expecting. That, this week, possibly, maybe even by the weekend, we could get a deal. I use these words, and I'm careful to use these words, especially using a lot of possibility and hope, because again, this is all politics. This is all, they come out and they say, they sound negative, and then they switch to positive, and the news picks it up, and then it trickles down into the markets itself. So we don't know for sure, but how the markets are reacting today is that there is some optimism in the pound, and there's some optimism that we could see some sort of deal, hopefully this week or by the weekend, especially as we approach that December 31st deadline, which is 2.5 weeks, which is, not so far. Once we get to this weekend, December 19th, we are just 2 weeks away. So hopefully something comes through. We'll have to see. But yeah, just to kind of give more of a background knowledge on this Brexit sticking points, there's 3 of them. 3 key issues to be talking about. So I'll kind of explain it here. So the reason why Brexit trade deal has been held over some time is because of the following issues. One is fishing. The 2 sides are split over 2 issues: quotas and access. In 2012 to 2016, we had 56% of the fish in UK waters was caught by EU boats, and 44% of UK boats. Britain wants both more quota to catch its own fish and ultimate control over who has access to the waters and in which areas. So reports suggest EU was prepared to return 18% of its current quotas to UK fishermen, but Britain demanded 80%. And the UK offered a 3-year transition to having control, but the EU reportedly wanted 10 years. So again, negotiations on just those key numbers. The second is level playing field. This means how closely we follow the EU rules in the future to stop us undercutting businesses on the continent. The UK wants to be free to set its own laws in areas like labor, environment, climate, and subsidies for businesses, which is state aid. But the EU demanded equivalence, with the UK mirroring EU rules in the future. The EU later dropped this demand and said Britain could diverge from EU rules. It would just face tariffs if and when it does so. There are still fears this could lead into lightning tariffs when the EU passes new law on, say, the environment, and Britain chooses not to, if Britain chooses not to copy it. So again, it's just the following of the rules, EU is expecting, they have certain laws that they abide to when it comes to all this environmental, climate, and subsidies for state aid for businesses. But UK wants to kind of, as they're doing Brexit, they want to have their own kind of freedom of how they choose their rules. Kind of makes sense because that's why they're doing Brexit, right? So third one is governance. The final key dispute is about how any future disagreements between the UK and EU on trade are resolved. The UK is confident there will be no role for the European Court of Justice, but exact arrangements are still being drawn up. So there's more information on this in the InfoVest newsletter that I send out every week. If you'd like to read more about it, visit www.infovesting.com. And you can get more of the information about Brexit through our newsletter. So silver, on the other hand, talking about commodities, I mentioned about gold before. It's picking up a bit as of today and overnight. Silver is in this kind of range mode. If the Fed does come out and they do sound dovish, we could see gold and silver, especially silver, break out It's kind of in this technical triangle formation, kind of a bullish flag. So if we end up breaking that key resistance level and the Fed is dovish, then we could see further up prices in silver. In other news, IPO fever hits also Canada, not just in the US, but in Canada it hits the highest level since 2014. Canada's IPO this year is valued at $5.72 billion, marking the biggest year for such deals since 2014. There were new shares issued in 88 Canadian company IPOs that have started trading this year, regardless of whether they're listed on domestic exchange or not. So IPO fevers continues to be a news not in just US but Canada as well. Something to watch out for, as it reminds us back in the dot-com bubble of all this IPO and everything out there. And last but not least is Bitcoin. Bitcoin is at the 19,000 mark and continues to edge closer to that $20,000 mark. JP Morgan says Mass Mutual, which is a life insurance company, is showed interest in purchasing Bitcoin, which signals kind of a widening demand for Bitcoin. There was $100 million purchase suggests adoption of Bitcoin is spreading from family offices and wealthy investors to insurance firms, pension funds, and more of these big high net worth companies are looking into Bitcoin as a place to allocate kind of like 1% of their wealth or assets into Bitcoin. So people are more kind of being okay with this idea of Bitcoin, and it still hasn't been ruled out. It still hasn't been banned, which is shows that demand is picking up back in Bitcoin, and we do expect to see that Bitcoin continue its rally to even the $25,000 mark, especially as demand continues to pick up and continues to be in this market, especially with a tight supply. There's not much Bitcoin out there, and the supply continues to shrink, so we can see the prices rise because of that. And we also heard CoinMarketCap suggested that demand of Bitcoin to increase. The market cap I think the current market cap right now is around $356 billion. With the interest of pension funds, insurance companies in US, Euro area, UK, Japan, and allocating especially 1% of assets into Bitcoin, it would result in additional Bitcoin demand of $600 billion, according to CoinMarketCap. So something to keep an eye on. In terms of today's trading week for economic data, we have kind of 8:30 a.m. manufacturing sales for Canadian numbers. Then we have the ECB lanes speaking at 9:05 a.m. Eastern time. This is all in Eastern time. And we have 9:15 a.m. For the U.S. manufacturing production. And then Bank of Canada Governing Council member Macklem to speak around 2:30. And then we have API crude numbers around 4:30 p.m. today. So nothing, some little bit data here and there, but nothing too big, nothing too major. And one thing before I leave, I do want to mention this. We are seeing a surge of biotech stock boom. Especially a lot of bio shares. A lot of bio shares out there seen this huge rally, especially with this vaccine and this virus resurgence. Just to put this in perspective, a key biotech ETF, the SPDR S&P Biotech ETF, has returned from January until now a 56.5% return versus the S&P 500, which returned 13.8%, and versus the S&P 500 health sector, which is at 9.6%. So the biotech ETF is way, way up. And I think there are many stocks out there that are way overextended, such as Moderna, Novavax, and these other biotech stocks that continue to see this bid up in their prices. There's more of this information on the InforVest weekly newsletter. So that's something to kind of watch out if you're interested. Just visit inforvesting.com if you would like to read more. And if you'd like to take our take, that's funny. If you'd like to understand our point of view of our this biotech stock boom and how we're kind of bearish, or especially because of how overextended many of these biotech stocks are and the amount of promises that we hear from these biotech stocks, kind of expect to see some sort of reversal in our opinion in these biotechs. So we kind of talk about that in that weekly newsletter. So if you're interested more and wanted to see more about even how we have positioned ourselves in these biotech stocks, feel free to subscribe to our weekly newsletter. We have two. One is a free one and one is a paid one. The free weekly newsletter, you can sign up easily. There's no cost. The Smart Money Report is more of a paid program for $30 a month. And that talks more of in-depth details of our kind of holdings and what we see. Remember, everything that is talked here and talked on the newsletter is for educational purposes. We are not an advisor by any means. Any decisions made on investments should be consulted with a registered investment advisor, and InforVest or Daniel is not liable for any decisions made from this kind of podcast or any of the reports that we have on inforvesting.com or social media. We're out there just showing and educating the community on our views and how we take things and use our strategies and how we have an edge among many traders and investors out there. So something to keep an eye on, especially with biotech. Something which, alarms me when you see 56.5% and many 56.5% rally compared to the 9.6% health sector rally, and many of these overextension in these stocks, especially when you expect that things to come to normal in the next 1, 2, 3 years. And especially with some of these vaccine stocks, the kind of experience they have rolling out these vaccines, and the way they make profits off of it, it's a little bit of a red flag that we see. So anyways, hope you've enjoyed the podcast. Hope you'll be joining us tomorrow. And this sums up for today, and continue to look out, for those key events. The Federal Reserve being tomorrow, the stimulus bill, hopefully something will pass out this week, BREXIT, maybe even something this week. So all eyes on that, and stay tuned for more. Thanks. Bye.